Takeover activity in the resources sector is starting to heat up again, with Shell and PetroChina teaming up for a $500 million bid for the Queensland coal seam gas outfit Bow Energy. While it's not a massive deal, there's increasing speculation that China is about to unleash a new wave of buying physical resources, having become deeply disenchanted with its huge investments in US debt. Stephen Letts reports.
China is absolutely flush with cash. Its foreign reserves are well over $3 trillion and rising rapidly on the back of a current account surplus that looks like being about $250 billion this year. Its economy is steaming along, growing at about 9% a year, and there's every likelihood it will be the world's largest economy before the decade's through. As voracious as its domestic economy is, it can't soak up the frenetic output from its industrial base, which is now responsible for about 10% of global trade. And while that surplus of cash is a nice problem to have, it's still a problem.
Particularly in a country where you've got a managed exchange rate, if you don't want the currency to appreciate and you have a big inflow of foreign funds, you have to take those foreign funds and push them out of the country again.
Those funds traditionally have been pushed into safe havens like US Treasury bonds, making China America's biggest foreign creditor, holding about $1.2 trillion of its debt. The head of the Economist Intelligence Unit's Beijing office, Duncan Innes-Kerr, says the very low returns and concerns about the greenback's future has China looking to diversify its investments, and that most likely means increasing its appetite for risk with mergers and acquisitions.
There's certainly going to be an increase. I mean, if we remember just 5 years ago, we were talking about Chinese outbound direct investment of merely sort of $10 to $20 billion a year. Now we're looking at that moving up by a factor of 10 in the next few years. Most people expecting $100 billion US dollars of outbound investment on an annual basis at least by 2012, 2013.
I hear that there's another wave on its way very soon.
Andrew Thompson is a former Howard government minister and has worked through Asia and the Middle East consulting on mergers and acquisitions and government relations. He says he's noticed a change in sentiment in Beijing of late.
Many large Chinese state-owned enterprises who have been eager to buy large-scale assets, especially in bulk commodities, have really been told to wait and see for the last couple of years. But now, perhaps triggered by the recent uncertainty in the market and some reductions in share prices, that the authorities in Beijing are now much more ready to give them permission to make these acquisitions.
China has a lot of money, but it's an error to think of it as China Inc. It's a set of large companies competing against each other for funds to be able to invest. And what we're seeing with China Minmet Corporation, who are our largest shareholder, is that they're supporting us to go out and grow in investments in the minerals area throughout the world.
Andrew Mitchellmore knows a fair bit about Chinese foreign investment. He ran Oz Minerals when China Min Metals bought it and a handful of mines in Australia and Asia for $1.4 billion 2 years ago. The new owners rebadged the company as MMG, kept the existing management and gave them a very ambitious growth target.
Our challenge is to be around 20 billion size within 3 to 5 years. That's a hell of a challenge. That's a growth of about 4 times. But you need that growth to build a platform, just as the big guys have done in the past. And then you keep building on that platform. And as you get it, you can then start justifying looking at tier 1 assets.
However, having been burnt badly, overpaying for assets before the GFC, the Chinese this time around are likely to be far more circumspect. A case in point was MMG's refusal to engage in a bidding war for the Australian-listed copper producer Equinox Minerals earlier this year. Its one and only offer was $1 billion less than Barrick Gold was prepared to pay.
In the past, it was, if I bid for something, I have to follow it through, otherwise I've lost face. Now, it is also, if I bid, I want to be successful, but I'm not going to bid to the point that I destroy value. that is also a loss of face. And I think that's a very important notion to have.
There's also a stratum of younger Chinese executives in the state-owned sector that have returned to China after education in the United States or elsewhere, and who have much more analytical approaches to these acquisition propositions. So the old days of a big checkbook being open and a big cheque being written for a project that was simply big, regardless of its quality, I think those days are over.
Ultimately, though, whether a cashed-up and acquisitive China leads to a dramatic rise in the value of assets depends on one thing.
Certainly asset prices in the resources sector will be strong so long as China's demand is strong. China is increasing its investment in these strategic sectors, as you mentioned, mining right up the top there of those strategic sectors. And obviously, if there's more demand from the Chinese side on top of the existing level of demand on the international stage, that will bid up asset prices.
And while the Chinese may be confident about their prospects at home, they still need the rest of the global economy in a healthy state to finance the operation. And that's far from a done deal.